Yes, I can see Daniel says yes. What about the rest? What about the rest? Confirm whether you are there. Just say yes. Yes, I can see a number of you are saying yes. I can see Michelle, I can see Cyprian. You are saying yes. What about the rest? Millicent, Harry, are you having that question? So confirm whether you have that question. Confirm whether you have that question. Yes, I can see Amos. I can see a number we are saying you have it. So it's the one you've written on the board, April 2023, question number 2. So if you look at the question required, suppose you can be able to go to the required very fast. We can be able to go to the required very fast. Remember, in this case, you said it is of essence that in this case, you try to save your time in the exam. You try to save the time in the exam. So if you look at the required, of course, in this case, you can be able to tell it is a group question. But what is required? We are required in this case to prepare a consolidated statement of profit or loss for the year ended 31st of March 2023. And also in this case, what a consolidated statement of financial position. Consolidated statement of what financial position. So it means in this case, you must actually be able to be having some knowledge at hand in this case as to how we can be able to undertake what preparation of the consolidated P&L and the consolidated statement of financial position. So of course, you can be able to go through the question and of course be able to understand what is actually required in the question. And of course, for group questions, there is something we said that in this case, you'll obviously in this case be able to start with. What do you start with? What are you supposed to start with when you're having to solve a group question? What are we going to, you start with what? The structure. You start with what? The structure. You start with the structure. The structure, in this case, it is normally how you can be able to come up with the structure in most of the instances. This information, you'll be able to get it in the introductory paragraph of the question. If not, you'll get it in note number 1 or note number 2 of the additional information. You'll be able to get it in the introductory information of the question. Or if not, in this case, you can be able to get it in note number 1 and of course, what note number 2. So of course, if you read the question, it's having to say, River Limited operates a fast-moving goods subsector. During the year ended 31st of March 2023, so of course the year ended, our year end, you must be able to take note of those dates. Year end is 31st of March 2023. River Limited expanded its operations by acquiring a controlling interest in Sai Limited. So of course, if they talk about a controlling interest, that is what? A controlling interest is, it basically means they had acquired what? A controlling interest simply means that was what? They'd acquired what? They'd actually acquired a subsidiary. It's what? It's a subsidiary. It's a subsidiary. Then in this case, they had a significant influence over the activities of what? Of Tutu Limited. Even without having to do the computations there, Tutu Limited will be what? To this group. Significant influence. Significant influence. It will be an associate. Because in this case, if it is control over the other, that other becomes a subsidiary. If it is significant influence, that term significant influence simply means that other one is an associate. Even without having to look at what the figures that you've actually been given to know whether this one is a subsidiary, those statements are already having to tell us. And then in this case, you're having to say, when you're having to start a group question in this case, we'll have river. We have river. In this case, then of course you have in this case what? Sai. Then of course you have in this case what? Tutu. We have Tutu. River, Sai, and of course Tutu. This one is of course what? A subsidiary. You've already been able to know. This one is what? Is an associate. Is an associate. We've already been able to know by that statement. The following draft financial statements for the year ended 31st of March 2023 relate to the three what? Companies. Relate to the 3 companies. So of course you've been able to say, if you don't get the percentages in that introductory paragraph, you can be able to check at note number 1 or note number 2. You'll be able to know what is in this case what the percentage of control or the percentage of what of significant influence. Look at note number 1 immediately without even having to go through those particular statements. Look at note number 1. On 1st of July 2022, remember the date of acquisition is actually very important. On 1st of July 2022, River Limited acquired 80% of Sai. So this one was 80%. It was on which date? You have to take note of that date. Take note of that date. It was 1st of July 2022. It was 1st of July 2022. So in this case, they acquired what? 80% for a cash consideration of 1,100 million. Of course, that will be able to help us to calculate what the goodwill. then the fair value of the assets and liabilities of SI Limited were equal to their carrying amounts at the date of acquisition. So there was no any form of revaluation of assets on acquisition. So that did not actually happen. Then the group policy is to measure the non-controlling interest at their proportionate share of net assets of the subsidiary at the date of acquisition. Who can be able to tell us what that statement is having to inform us? The group policy is to measure the non-controlling interest at their proportionate share of the net assets of the subsidiary at the date of acquisition. Who can be able to tell us what that statement is having to inform us? We are going to use what? The partial method, Joseph. We are going to use what? The partial method to calculate what? Goodwill. We're going to use the partial method to calculate what? The goodwill. Remember, in this case, we said, whenever you hear about, in this case, NCI has been measured at fair value. This one automatically means what? At fair value. This means full method. Use what? The full method. If here, in this case, NCI has been measured at the proportionate. So you use what? Partial. Use the partial method to calculate goodwill. So the examiner uses that language, proportionate. So P, proportionate, you use the partial method. When you hear the NCI is measured at fair value, you use the full method to calculate goodwill. That is what that statement is having to inform us. Then number 3, on 1st of January 2023, River Limited acquired 40% of these other ones. So already we can be able to tell this one was what? 40%. That one was in this case what? 40%. And therefore, that was the significant influence in what? In the asset. Of so much importance, remember the date of what? Of acquisition. The date of acquisition in this case was on which date? 1st of January 2023. So it was on 1st of January 2023. These dates are very important because now in this case, you can be able to know at which particular point in time a subsidiary or an associate was actually acquired. So that in this case, when you are preparing the statement of income, you can in this case appropriately apportion the expenses of the subsidiary. Remember, in this case, for the associate, you don't consolidate. You don't consolidate. You take the share in the profit after tax when you're coming up with the income statement. And therefore, you can, in this case, very quickly be able to have these financial statements. We are preparing them. Look at the date we are having to prepare them, 31st of March, 2023. This one was acquired on 1st of January, 2023. So it means this one was in existence for how many months? The associate was in existence as a member of the group for how many months? 3 months. This one was actually what? 3 months. And this one was acquired on 1st of July, 2022. This one was in existence for how many months? The subsidiary. The subsidiary was in existence for how many months? So this one we've already been able to see 3 months. This one was for how many months? 9 months. It was in this case for what? For 9 months. It was in this case for what? For 9 months. It was for 9 months. So it means when we'll be coming up with a statement of profit or loss, we need in this case to apportion the expenses of this subsidiary for a period of how many months? 9 months. Do we apportion the assets in the statement of financial position? Do we apportion the assets in the statement of financial position? Do we apportion? No, we don't apportion. We don't apportion. You add them line by line. You add them line by line. The only items you'll be able to apportion according to time of existence will only be what? The items in the income what? Statement. The items in the income what? Statement. And then we can be able to continue with the additional information. So you're told in this case, number 4, during the post-acquisition period, River Limited sold goods to Sai Limited for 300 million. That is an intercompany sale, which in this case we have to eliminate. Reported 20% profit margin on this sale. Half of these goods remained in the inventory at the end of the period. So there will in this case have an intercompany sale. Then of course what? URP. We'll have URP in that statement. Then number 5, included in the trade receivables of River Limited was 80 million due from Sai Limited. That is what? An intercompany balance. An intercompany balance, which in this case we have to eliminate from the trade receivables and the trade payables. So included in this case in the trade receivables of River Limited was 80 million due from Sai Limited. In the books of Sai Limited, the amount due to River Limited was shown at 60 million because Sai Limited had remitted shillings 20 million, but River Limited had not recorded what? The remittance. That 20 million, what do we call it? The 20 million, what will you be able to refer to it here? That 20 million will be able to refer to it as what? We'll refer to it as the 20 million. That's 20 million. Sai Limited had remitted 20 million, but River Limited had not recorded the remittance. We'll call it what? Cash in transit. To likely go to the cash in transit. So then on the number 6, on 1st of October 2022, River Limited sold an assembly plant to Sai Limited for 400 million, reporting 25% profit margin on the selling price and netted off the profit against what? The cost of sales. So the group charges depreciation on plant at the rate of 20% per annum, on cost on full year basis in the year of what? Asset purchase, and none in the year of what? Of disposal. So impairment test carried out on 31st of March 2023 revealed that neither the goodwill on acquisition nor the investment in associates had been impaired during the year. So there was no any impairment. So we'll be calculating the goodwill for 2 of them. There will be no any form of impairment on the goodwill. None of the group companies had paid dividends during the year 31st of March 2023. So in this case, you are called upon in this case to prepare the consolidated income statement, and of course in this case what? The consolidated statement of financial position. So if in this case we are to 7 time, we already in this case we have our structure there. And of course I hope you've been able to write this one, because now in this case I just want to be able to present the structures of in this case the final accounts very fast, even before in this case we look at what the workings start having to give us a headache. So in this case we are preparing the River Group statement of profit or loss, statement of profit or loss for the year ended. It is for the year ended 31st of March 2023. 31st of March 2023. Our figures in this case are in shillings of millions. And therefore, what are we having to combine here? It is the items in the statement of profit or loss. You need to look at the items in the statement of profit or loss. You've actually been given there as the first table. And therefore, in this one, we normally start in this case with what? The revenue. Of course, for the revenue, if in this case you remember, in the additional information, there was what? An intercompany sale. It normally affects what? Revenue. So you can leave it there. Go to the cost of sales. We had about what? Unrealized profits on closing stock. It normally affects cost of sales. So we'll leave it there for now. Then in this case, we can be able to have in this case what? Our gross profit. So it means for this one, of course, you need to leave here some space. Because there'll be some markings here. So we'll be able to take 4190. We add on. Remember, it is apportioned because it has to be apportioned for 9 months. This one existed for 9. That's why you're having to say it is important you come up with the structure and be able to understand the time period upon which it existed. So that in this case, you can be able to know how will you be apportioning what? The expenses. So it means for these ones of the subsidiary will take 9/12 times, in this case, that amount of 2600. But there'll be a number of adjustments here, which in this case, you must actually be able to consider. You'll be able to put there. So then in this case, we go to the cost of sales. So cost of sales, we have 2730 plus 9/12 multiplied by 1400. So there'll be a number of adjustments here. So you can be able to leave it for now. So with this one, then you can be able to get in this case what? The gross profit. We can be able to get the gross profit there. We can get the gross profit. So after the gross profit, in this case, you have what? Distribution costs. Distribution cost. Let me in this case ask, have you heard about anything about distribution costs in the additional information? Is there anything you're having to hear about distribution cost in the additional information you've just gone through? Are you hearing anything about distribution cost? Is there anything about distribution cost? There's none. What does that tell you? In this case, what you'll be able to do in this case, you'll take it is actually 300 plus 9 out of 12, multiply in this case by 200, and you close the chapter. What is the figure you're having to get here? Of course, for this one, you haven't gotten. What is the figure here? 300 plus 9 out of 12 multiplied by 200. You get how much? You get 450. So that when you close the chapter, you've already been able to score your mark there. In this case, you have what? Admin expenses. In this case, you have distribution cost and admin expenses. Administration expenses. In this case, we have 500 plus 9 out of 12 multiplied by 400. Have you heard anything about this one? None. What is the figure you're getting here? What is the figure you're getting here? Mm-hmm. 800. You're getting 800. 800. Yes, you're getting 800. So you put 800 there. Remember, these ones you are deducting. These ones you are deducting. Then we'll be able to get profit from operations. We'll have the profits from operations. We'll have the profit from operations. So we'll be able to put our figure there. We go to the next one. In this case, investment income. We have in this case investment income. Investment income. So this one is also in this case not actually affected in any way. So we'll be able to take 40 multiplied by 9 out of 12 multiplied by it is how much? 20. Exactly 20. So what do you get? 40 multiplied by 9 out of 12 multiplied by 20. You get, I think, 55. So it will likely be 55 like that, 55 like that. Then the next item is actually what? Finance cost. Is actually finance costs. In this case, we'll have finance cost. Finance costs. Finance cost. So finance cost, in this case, we have finance cost is 80. It will likely be 80 multiplied by 9 out of 12 multiplied by that amount of 60. What do you get for the finance cost? What do you get for the finance cost? There's also no any form of adjustment regarding the finance cost. Nothing in this case will actually be talked about. Any interest that was actually in this case, for example, affected. So what do you get as the figure there? You get 125. You get in this case what? 120, 125. You get 125, so you can be able to deduct there. So with these ones, then in this case, you go to the next, which is actually what? Profit before tax. You get the profit before tax. Before tax. Remember, we have a line here. The profit before tax, which you can't be able to place the figure because we haven't actually in this case been able to do the other figures up there. We have the income tax expense, but in this case you have to remember we'll have to add something there. So you have the income tax expense, income tax expense. In this case it will likely be 180 plus 9 out of 12 multiplied by 160. So what do you get? There's a figure you'll be able to get here. There's a figure you're getting there, 180 plus 9 out of 12 by 160, you get what? 300. You get 300, so it will likely be 300. 300, you deduct. But there's something you're supposed to add here. Who can be able to tell us? There's something you're supposed to add there. Of course, you have reached almost the tail end, but there's something you're supposed to add here. Share of profits in the associate. So share of profits in the associates. Remember the associate, we don't actually consolidate. We use the equity method. In the income statement, you can be able to see we've not been adding the items for the associate. You don't add. Associates, you don't consolidate. Use the equity method to account for them in a group. So share of associates profits after tax. Share of associates profits. Associates profit after tax. Profit after. Share of associates profit after tax. So in this case, you'll be able to take, so the associate profit, how much is the associate profit? Exactly in this case, how much? 200. Exactly 200. So it is, you can be able to see it. In the associates, you can see the profit for the year. The profit after tax, the part for the associate, you can see the figure for 200 down there. You can be able to see it. So in this case, you'll be able to take 200. But remember, these associates, that is the profit for the entire year. That is the profit of the associate for the entire year is 200. But now remember it existed for how many months? 3. So you'll be able to take what? 3 out of 12. 3 out of 12. Then in this case, we have what the percentage. The control was in this case, the significant influence was 40%. So you'll have to multiply by 40%. What do you get? So the significant influence in that unit is 40%, but also it existed for only 3 months. What do you get? This is what you will be able to get that. You're getting what? 20. You'll get 20. So therefore, you should be able to, in this case, add 20 there. And therefore, with that, you'll actually be able to get, in this case, what? The profit for the year. You'll be able to get the profit for the year. The profit for the year for the group. Profit for the year for the group. Profit for the year for the group. So what does this tell you? That in this case, you would have already been able to score a mark here, 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 without having been able to. There are only 3 items that in this case you have to solve here. So, and of course, in this case, you can be able to save on time, because by the time you start processing cost of sales, mix up in your workings, if you start the workings, you are mixing up yourself, you might end up, by the time you reach here, is already in this case 30 minutes gone. 30 minutes gone. But there are those items that in this case, like this one, you can be able to see, it doesn't need any form of adjustment. These are the items that in this case, of course, I know at this particular point in time, you are so much familiar with group questions. Having already done in class, you are so much familiar with what group questions. You know that this one, it rarely needs an adjustment. This one, it will have an adjustment. It will end up having to have what? An adjustment. Major in what? In the income statement. But this one, like this one, distribution admin, income tax 0. Income tax 0. So in this case, we can actually be able to also, in this case, come up with what? You can leave them, so we'll be able to do them. You'll insert them. So you can be able to come up with what? The structure for the statement of financial position. 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 It is River Limited, River Group, Limited statement. Statement of financial position as at 31st of March 2023. 31st of March 2023. So these items of the statement of financial position, you add them line by line. You don't actually end up having to do what? Apportion them. They will actually apportioned for, in this case, what? The statement of income. So in this case, our figures are actually in shillings of millions. So actually in shillings of millions. So of course, we are starting with what? The non-current assets. Non-current assets. We are starting with the non-current assets. So of course, you have what? Property, plant, and equipment, PPE. So this one, you actually add for the holding company and the subsidiary. You don't add those items. For the associate. Instead, for the associate, which figure will you be able to calculate? The items for the associate in the statement of financial position, you don't add them line by line. But there's a very special figure you'll be able to calculate to represent the associate here. We call it what? There's a name we give to it. We won't actually consolidate the associate here, but we'll be able to calculate what? Someone says NCI. We'll be able to calculate what we call what? Investment in associates. Investment in associates. So we don't consolidate associates. We won't actually consolidate two. But under the items of assets, we'll be able to put another figure we call investment in what? In associates. And then in this case, you are moving very fast because you want to be able to do at the same time. So 2070 plus in this case what? 1290. So this one will actually be affected, for example, in this case, if there was what? An intercompany sale of a fixed asset. If there was an intercompany sale of a fixed asset, it normally affects this particular item here. So you can be able to leave it for now. Then we go to what? Investments. We go to investments there. Investment in this case, you've actually been given a figure of there 1600, a figure of 1600. So with these investments, if you look at the amounts that in this case were invested, the amounts that were invested as a purchase consideration, you can see for the subsidiary they paid how much? 1100 And of course, for the associate, they paid in this case an amount of 500. So when you see that item of investment, it is only having to appear where? Is appearing only where? In the holding company. So these are the investments they had done. These are the investments they had done by having to pay those other companies. And therefore, in this case, if those investments were done, what normally happens is like an exchange of money from one member of the group to the other. You normally eliminate them. And then in this case, it will likely be 1600 minus that 1100 minus the 500. It actually remains to be 0. It remains to be 0. It's just like the same as what an intercompany balance. What we say, you eliminate them. So in this case, these amounts were actually paid in this case to what? To the associate, and of course also to what? To the subsidiary. So you have to remove them by crediting this investment account. You have to remove them, and therefore they'll be able to go to what? To the purchase consideration. What is having to happen? You are debiting the purchase consideration, debiting purchase consideration, within this case 1100, with in this case what? 500. Then you are crediting investments. That is how the entry actually goes. So with these both amounts, 1600. So it means you'll be able to eliminate them here, and therefore here we'll be able to have what? 0 like that. We'll have zeros like that. We'll end up having to have a 0 like that, a 0 like that. And therefore, another item that will be here, it will likely be goodwill. We haven't calculated it. It will be goodwill. We'll have investment in associates. Investment in associates. We haven't calculated it. We'll be able to calculate it, and then we'll be able to get a total there for the non-current assets. We can be able to go to the current assets. Current assets. We can be able to go to the current assets. So for the current assets, we have what? Inventory. We have inventory. Also, you take what? For the holding and the subsidiary, it will be 530. 530, you add on, in this case, what? 390. This one, at this particular point in time, you must have already been able to know. It is affected by what? This one will be affected by what? If you are thinking very fast, in this case, you are processing very fast, it will be affected by URP. And therefore, you just leave it for now. It will be affected by URP. Then in this case, we go to what? In trade receivables. Trade receivables. We have trade receivables. So in this case, we have 640 plus 470. But this one you must have already known. It will likely be affected by an intercompany balance, which we've already been able to see in the additional information. That's what you're having to say. When you're going through the additional information, you must be very alert. You must actually be very alert. Which item is having to be affected? We've already seen the additional information that in this case, there were some intercompany balances, which normally affect this item. Don't put the figure for now. Just leave it there. We go to what? Financial assets. Financial assets. We go to financial assets. So in this case, we have 300 plus 150. Have we had anything about financial assets in the additional information? Anything we have had about financial assets? Is there anything we've had about financial assets? There is none. So there's nothing. So it means in this case, this one is comfortably what? A figure of 450 here. We go to the next item, which in this case, we got cash and bank balances. So cash and bank balances. Cash and bank balances. I don't know whether you're able to see that. I think you can be able to see. We have in this case what? 360. 360 plus 200. 360 plus 200. Who can be able to tell us? This one will be affected by what? This one will be affected by what? There's an item you had already mentioned to me. There's a cash in transit, which was an amount of how much? It was an amount of, the cash in transit was an amount of how much? So it was an amount of 20. So what do we do here? Do we add or we less? 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 Wait, David, you are saying less. We add. The cash in transit you add. So in this case, you'll be able to add it here. You'll add 20 here. You'll be able to add 20 there very quickly. So because you are trying to save on time, even without having to do the workings, add. What do you get? 360 plus 200 plus 20. The cash in transit you add. You add. Because what will happen, if you look at that note, the reason as why in this case you're having to add, if there's any cash in transit involved in an intercompany balance, these are the entries. You debit the trade payables, you debit the cash in transit, you credit the trade receivables. So therefore, if you look at there's actually 80, this one will be 60, this one will be 20. Suppose you haven't gone there, but that is why you're having to add. So you add it, and therefore you'll be able to get what? I can see you're saying 500. I can see you're saying, is it 500 or 480? 580, it is 580, sorry, it is 580, 580 like that. So is there any other item? So there's no any other item there, and therefore we should be able to get the total assets there. We should be able to get the total asset there, because you can't put the figure because there are some figures here, which in this case we need to be able to get. So, and therefore we can be able to go to the other side. We can be able to go to the other side. You can go to the other side. So that other side, we have what? Equity and liabilities. Equity and liabilities. We have equity and liabilities. For the equity, in this case, we have what? Ordinary share capital. Ordinary share capital, which figure do we place here? Ordinary share capital, which figure do we place here? Which figure do we place there? Ordinary share capital. For the parent, you pick the figures for the parent. There is no calculation. You pick that mark very fast there. Pick that mark very fast there. Share premium. Share premium. Share premium. It is in this case a figure 5. You also pick for the parent. But now here there are some items you must be able to add. 2 of them. There are 2 items you must be able to calculate. Which are these 2 items? The 2 items are which ones? What are the 2 items that you must be able to calculate and also add here? Retained earnings and, of course, what? NCI. So retained earnings, which you have to calculate. Then in this case, you have also NCI, which also you have to calculate. You can be able to leave it like that. You can be able to go towards the non-current liabilities. Non-current liabilities. We can go to the non-current liabilities. For the non-current liabilities, we have in this case 12 loan notes. We have loan notes. Loan notes. Have we heard anything about loan notes in the additional information? Anything about loan notes? Is there anything about loan notes in the additional information? When we started to read the question, we are in this case to be very alert. There is none. So in this case, what it means you'll do there, you need to be able to pick this particular mark here very fast. So 640 plus 480. So what do you get? There's a figure you'll be able to get here. 640 plus 480. Then the next item is what? Deferred tax. Deferred tax. Deferred tax. Deferred tax. Anything about deferred tax we haven't had. So 260 plus in this case what? 100. So this comes to 360. What about the first item there? Loan notes. Loan notes you are getting 1120. So it is actually 1120. So we go to the current liabilities. Current liabilities. We go to the current liabilities. So the current liabilities. For the current liabilities, in this case, you have trade payables. Trade payables. This one, obviously, it has been affected because you have what? An intercompany balance. So we'll be able to put here, in this case, 420. We add on for the subsidiary 330, but we can leave it because there's that item in the additional information which was having to talk about what an intercompany balance. You can leave it that blank for now. Then we go to the current tax. We go to the current tax. In this case, we'll be able to have, in this case, what? 160 plus 90. So you'll be able to get what? 250. 250. So with this, you'll be able to get the total equity and liabilities. Total equity and liabilities. So like that. So you'll be able to, in this case, I've already scooped here, 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 and mark in this case, these marks you're having to get here are same with the ones you'll be able to get in these workings. If here they're allocating 2 marks, here it will still be 2 marks. Here it will still be 2 marks. If they're allocating here 1 mark, this one will still be 1 mark. This will still be 1 mark. This will still be 1 mark. Everything will be, even this one, imagine, the way it is normally confusing, it will still be 1 mark. It will still be 1 mark. That's what you're having to say. If you take this kind of an approach, you might end up having, in this case, to maximize on the number of marks you might actually end up having to get before, in this case, you even start having to do what? Mix up yourself. That head of yours having to mix it up with what? These are a lot of what? Workings. These are a lot of what? Workings. Because time is of what? Of essence. As I told you, in this case, this particular paper is not actually difficult. The way the difficult will actually end up having to come in time. Time. If you've ever not been caught out by time in an exam, then this is the paper. You'll be caught out if you're not actually very keen. So if you start doing the workings, they might end up having to take 45 minutes or even 30 minutes. You haven't, in this case, even been able to draw the structure. There are those kind of entries that don't need any kind of adjustment. And once in this case, you so much comprehend questions about group, you'll be able to tell them very fast. Like in this case, you know that in this case, PPE, it will be affected. If there's an intercompany sale of a fixed asset, it will be affected. Inventory is normally URP on closing stock. It will affect it. Trade receivables, if there's an intercompany balance, it will affect it. It will affect this one. And of course, what these other items, what trade payables. Like that. But some of the items you might, like deferred tax, you'll get zero adjustment. Current tax, zero adjustment. These ones, you pick the ones for the parents. You pick the ones for the parent. Then now, once you've been able to do this, you can now start having to mix yourself with a lot of what workings. Now, in this case, you can look at those notes that in this case, you can be able to very easily, in this case, very quickly be able to adjust and of course, make our entries here and complete them as we move on. For example, in this case, if you look at in this case, what? Note number 4. During the post-acquisition period, River Limited sold goods to Sai Limited for 300 million. That means in this case, you have to do what? Deduct it from the cost of sales and also what? The sales. So in your income statement, that particular first statement in note number 3 is having to say, during the post-acquisition period, River Limited sold goods to Sai Limited for 300. That's what an intercompany sale is. An intercompany sale. Intercompany sale. That would be like your first working intercompany sale. So that is what working one. Working one. So what happens to that one? You actually end up having to do what? You debit the sales, and of course you do what? Credit the cost of sales. But if you've already comprehended it, you'd rather even not even be able to write. Just go there and minus. Have you minused? Have you minused in your book? Have you already minused? Have you already minused that one? You've already adjusted that one. It is minus on the sales and minus on what? On the cost of sales. The 300. It is an intercompany sale, which you have to, in this case, do what? Eliminate. So confirm whether you've eliminated because you're supposed to move to the next statement and adjust as we move on very fast. Have you been able to minus? Confirm whether you've been able to minus that intercompany sale in note number 4. Intercompany sale, you've been able to minus. Then you go to the next statement. It is having to say, River Limited reported 20% margin on sale. On this sale. So half of these goods remained in ending inventory of Sai Limited at the year end, 31st of March 2023. So that particular statement tells you in this case, you must be able to calculate something we call the URP, or the unrealized profit on the closing stock. The unrealized profit on the closing stock, the URP on the closing stock, the URP on the closing stock. So that would be, in this case, be still under working number 1. So URP on closing stock. URP on closing stock. So you are having to be told half of these goods were still in stock. So how much of these goods are having to be sold? In this case, they sold goods of an amount of 300 million. And the profit margin within this case was 20%. So therefore, you'll be able to get how much? You'll get 150. Is it 150? Confirm whether it is 150. Is it 150 or how much? So of course, this one is 150 times 20. You'll be able to get 30. You'll get 30. You'll get 30 as the URP. You'll get 30 as the... And remember, this one should be the margin. If you've actually been given the markup, you convert to a margin. In our question, they have given us this as a margin. If you had actually been given a markup, you convert to a margin. But already you've been given a margin. And therefore, with this URP on closing stock, you must be able to know how do we normally treat it. So what will happen here, you have to, in this case, debit the cost of sales, or in this case, what you say, what retained earnings. Then in this case, we credit what? The closing inventory. This, when you credit closing inventory, it means you deduct. So automatically, come deduct here 30 very fast. Deduct here 30 very fast and put the figure there. What is the figure there in the statement of financial position here? You've already been able to say debit cost of sales, credit cost of closing inventory. So come adjust here and get the mark here very fast. So it is 530 plus 390 minus 30. What do you get there as a figure? You get what? 890. I can go see you're saying 890. You would have already been able to clear that one. Then go to the statement of income under the cost of sales. Add If you are debiting the cost of sales, it means you are adding. So it means in this one you are adding, in this one you are deducting. Add this 30, you would have already been able to adjust that one. And of course, you would have actually completed note number 4. Note number 5. Included in the trade receivables of River Limited was 80 million due from Sai Limited. That's in this case what we call what? An intercompany balance. Intercompany balances. They should actually be eliminated. Intercompany balances should actually be eliminated. But of course, sometimes there's usually an element of cash in transit. So if in this case there's an element of cash in transit, what is supposed to happen? You need to, in this case, debit the cash in transit with that amount of the cash in transit. You debit the trade payables. You credit, in this case, the trade receivables. The trade receivables. For the trade receivables, you'll be able to credit with the full amount of, in this case, 80. The cash in transit here was actually 20. And therefore, in the trade payables, what is remaining as 60 is what you'll be able to end up having to debit. If there's an element of cash in transit, debit the cash in transit, debit the trade payables, credit the trade receivables. If there's not this element here, just debit the trade payables with the full amount. So if this one was not there, I would have said debit trade payables by 80, credit trade receivables by 80. But there's an element of cash in transit, which has not actually been received that other side. And therefore, in this case, you debit what the cash in transit, which we have already adjusted. This is cash they had not received, but is on the way, it is having to come. So it is increases what? The cash for the group. That member of the group, you add it here. That's why you are debiting the cash in transit. Alternatively, you can be able to add a different item here. You just close these ones and put a different item, cash in transit 20. But you can be able to add it on what the cash and bank balances. Then you've already been able to know how you're going to treat the trade payables. Go to the statement of financial position, deduct. When you're debiting trade payables, it means you are deducting. You are deducting. When you are creating trade receivables, it means you're having to deduct. So in this case, in our trade receivables here, we need to deduct a figure of 80. So what do you get here? What do you get here? 640 plus 470 minus 80. To basically do that, 640 plus 470 minus 80. There's a figure you'll be able to get here. You get 11. Is it 1030 or 1130? Joseph, how is your calculator working? Check your calculator. So 1030. What about the trade payables? Have you adjusted? What is the figure you're having to get for the trade payables? Trade payables, have you minus 60, that other side of the statement of financial position. You're getting how much? 690. So 690 is actually correct. And of course, you'd have completed that. You'd have already made your mark here. And of course, that other one for the trade payables already, you made that mark. You go to the next statement, number 6. On 1st of October 2022, River Limited sold an assembly plant to Sai Limited for 400 million shillings at a 25% profit margin on selling price and netted off the profit against what? The cost of sales. Netted off the profit against, in this case, what? The cost of sales. The cost of sales. So in this case, there are two items that you'll likely end up having to calculate there. So hope you've been able to write these ones because I want to do that final working. Actually, it is our very final working. It is our very final working. Then I think we'll be remaining with the elephants in the room. We will be remaining with the elephants in the room. We'll be remaining with the elephants in the room. We'll be remaining with the elephants in the room. So in this case, that is what an intercompany sale of fixed assets. An intercompany sale of fixed assets. There are two items here we have to calculate. What are these two items? The first item is what? There are two items here you have to calculate. The first item there are two items. If there's an intercompany sale of a fixed asset, there are two items you'll end up having to calculate. URP, one of them is URP, and of course, in this case, what? Depreciation. It is URP. And of course, in this case, what? Depreciation. Depreciation overcharge. So in this case, for the URP, you have to look at, in this case, how much was the value of the asset having to be sold. In this case, you are told the value of the asset having to be sold, in this case, was how much? 400. And therefore, you'll be able to take 400 times the profit margin. That profit should actually be given as a margin, which was in this case, what? 25%. You'll be able to get, in this case, what? 100. So with this URP, unrealized profit on the sale of the fixed asset, you must be able to know the entries you'll end up having to make. So in this case, you'll be able to debit the cost of sales, and in this case, credit the property, plant, and of course, what equipment. Then the depreciation overcharge will likely be on this amount. Remember, we've been told that in this case, depreciation they're having to charge at 20%. So you'll be able to take 20%, multiply by this amount that was over and above the item of property, plant, and equipment. We have already removed it, but now there was an overcharge when they calculated depreciation. Instead of doing at 300, it did to 400. They overcharged, and therefore it was on this amount, which in this case you have to take 100, which will end up having to come to what? 20. It will come to 20. So with this one, you'll actually end up having to debit the PPE, property, plant, and equipment. And of course, in this case, you credit what? The cost of sales. You credit the cost of sales. So therefore, you can actually be able to see here, we've already been able to make an adjustment here, which is on the property, plant, and equipment. You come here and actually say what? Minus 100, but we've added some amount. We've debited this one plus 20. Plus 20 like that. And of course, you would have already been able to adjust that item. So what do you get in this case as the value of PPE here? What do you get as the value of PPE here? So it is 2070 plus 1290 minus 100 plus 20. You get 3280. 3280. We've already scooped that. Then go to the cost of sales. The cost of sales, remember you had already done in this case an adjustment on it. Go to the cost of sales. We had minus an intercompany sale of 300. We had minus an intercompany sale of 300. There was also in this case what? Unrealized profits on closing inventory of 30. In our previous working, there was unrealized profit on closing inventory of 30. Which in this case we were supposed to add. Hope you added. Then also in this case adjust these items. So add on this 100. Then of course also in this case you do what? You less this 20. When you are creating the cost of sales, it means you are deducting. When you are debiting, it means you are adding. So add on the unrealized profit on the sale of intercompany sale of the fixed asset over 100. Then you minus this 20. You minus the 20 there. Then you do the calculation in this case for the cost of sales and tell me the figure. Just tell me the figure once you've been able to do it under your cost of sales. So adjust these two. But remember, there were two other adjustments we had done. When you talk about having to debit the cost of sales, debiting an expense account, it means you are increasing it. So you'll add. Crediting an expense account means you are deducting. So add on this unrealized profit on the sale of intercompany sale of the fixed asset. You minus the depreciation. They had overcharged an expense. Now remove it. Remove the 20, you credit it. Then tell me the figure you're getting. You're getting what? 3590 is correct. You must be getting 3590. 3590 is the correct figure. Then also in this case, under the sales figure, the revenue had actually deducted how much? 300. Tell me the figure you're getting for revenue. In the income statement, the figure you're getting for revenue, I can be able to see whether it is correct or you've just gotten your own things. We had deducted an intercompany sale of 300 only. So it is what? 5840. Maureen says 5840. Others should be able to confirm. I should be able to see a number of you having been able to confirm so that I can be able to know you are on the same page. 5840. So we had deducted 300, which was an intercompany sale. That was the only adjustment. We've closed on cost of sales. We've closed on, in this case, what? Revenue. Is there any other item having to remain in the income statement? Confirm whether there is any other item in the income statement remaining that we haven't, in this case, been able to deal with. Is there any other item remaining? You simply say yes or no. You need to be very fast or very quick. You simply say yes or no. Income tax expense, you've already done. We had already done it. We had already calculated it. You should be able to tell me no. There's no any other adjustment that we haven't done. What is remaining is the total figures in that income statement. Income tax expense, you've already dealt with it. 180 plus 9 out of 12 multiplied by 160. So now add the totals in the income statement. Starting from the revenue, you minus cost of sales, you get a gross profit. Under gross profit, put a figure. Move on like that. Then you tell me the very, very final figure you're having to get. Just tell me the very, very final figure you're having to get. The income tax expense you already, in this case, adjusted. Unless Maybe you missed out on that one, Daniel. We had said 180 plus 9 out of 12 multiplied by 160. So what do you get as the profit for the year? What do you get as a profit for the year? Maureen, that's 2250. Move down, continue until you get the final figure. That is just the gross profit, Maureen. We've already done everything in the income statement. Speed is of essence. Speed is of essence. The very final figure you are getting in that income statement. That is the gross profit, Maureen. But now I want the very, very final figure. It is 650. 650 should actually be the correct figure. 650 is the correct figure. Sawa is the correct figure. 650 is the correct figure. So Maureen, have you reached there? Maureen, have you reached there? Or you're getting your own things? 650 is the profit for the year is supposed to be 650. That is the correct figure. $650 is the correct figure. So what is remaining now in this case is what? It is goodwill. It is investment in associates. Then NCI. Then of course in this case what? Retained earnings. Retained earnings. Those are the 4 items having to remain. Those are the 4 items having to do what? To remain. So you can do them as a very, very final items. So for those ones, we'll be able to handle them tomorrow. We'll handle them tomorrow. So what I was trying in this case to drive home, some of the figures in this case don't need complicated adjustments. What you need to do, start with what? The structures. Draw the structure, know the subsidiary, the associate, then immediately draw the income statement structure. There are those items that don't need any form of what adjustment. Admin expenses don't need. Distribution expenses don't need. Cost of sales, it must have. It rarely needs an adjustment. It must have. Revenue is must have. And mostly in this case for revenue, is just normally an intercompany sale. The one that has so many adjustments is the cost of sales. Depreciation undercharge or maybe overcharge, the intercompany sale and realized profit on a sale of fixed assets. It will affect the cost of sales. When you go to the statement of financial position, some figures, zero adjustment, actually, deferred tax and current tax, they will never have an adjustment. That is a free mark you would have already been able to score. So by the time you're having to mix yourself with these calculations here, Maureen, you must have already scooped so many marks. So many marks, you've already scooped them. You've already scooped them to save on time, And in this case, in any case, you realize that time is not on your side. Maybe this was the question you're having for the very last time. Maybe you are almost remaining with one question that you are, like in this case, sure, professional firms, that is very easy. And this one has taken quite some time to reach this particular point here where you are missing these figures. Leave them and move to the next question. You'll come to do them once you've completed that other question. These ones, they likely mix you up if you're not actually very keen. But of course, if you are very fast and you are very sharp, you can be able to do them and actually start them immediately. But if you feel like in this case, you are not ready to do, and time is of essence, you are remaining with 30 minutes, and there are 2 more questions to do. Move to the next questions, complete. Then maybe in this case, if you have time, come and actually complete these ones. Plus the NCI and retained earnings. So we'll be able to look at, in this case, how you could have been able to come up with those figures for retained earnings, NCI, and in this case, what? Goodwill, and of course, now in this case, what? Investment in associates. Otherwise, we can be able to end there for now. My point was, in this case, just to be able to tell you, is a way you can be able to make things move very fast for group questions. If you are very smart, you are very keen, you are very alert as you're having to do what? The exam. So you have to be very keen as to what is happening. Then you can be able to come up with the structures first of all. Then in this case, just do the adjustments as you put the figures, as you now get the marks as you go. Like that. Then the most difficult parts, you do them as the very final parts. So I think that's it. That's it. Have we put cash in transit separately to scoop an extra marker? Yes, you can put it as a separate item, cash in transit, or you can be able to put it under what? You can put it under the cash and bank balances. You can put it after this, you can put it down here. You can put it down here. So it will depend with the marking scheme. So maybe you can also be able to get a mark for it. You can be able to get a mark for it. can be able to get a mark for it. So for tomorrow, we'll be able to meet, I think it will be almost, it will be between 11 a.m. It will be maybe 11 a.m. Up to 2 p.m. Between these hours, but I'll be able to communicate. I'll be able to communicate so that I can be able to show you now how you come up with these figures: goodwill, investment in associates, NCI, then of course now in this case what retained earnings. Retained earnings. Retained earnings. Retained earnings. Evening class. I don't know what Nsioka means by evening class. What do you mean by evening class? Shall we have a class? Yes, we have a class at 6. We are meeting at 6. We are meeting at 6. So it is a marathon of revision. Cyprian, you are wishing I say no. Cyprian, you are wishing I say no. We are meeting at 6. Today we are meeting at 6. Then at 6 we won't do these ones. At 6 we'll be able to look at topic number 2. So borrowing cost and those others. So remember what I told you yesterday, we'll be able to look at borrowing cost. The question is in topic number 2. Topic number 2. So this one we'll just be able to create another time. I'll be able to take you through goodwill, investment in associates, and of course retained earnings, and of course NCI. Yes. What of the makeup class for the missed class? I can see Michelle is asking for that one. So, but at least if I create an extra time tomorrow, that will be able to cover for that. If I create an extra time tomorrow, that will be able to cover for that class we missed. That class we missed. So I think that's it. So let's meet some other time. So have a good afternoon. We'll meet in the evening.